Title of the talk today, extremely uninspiring. Transitions. I mean, really what I want to talk about is there's 2 or 3 fairly large macro things going on. I don't think any of us really know how some of this stuff is going to play out, quite honestly, but it's something the big markets and the smaller junior markets by extension are going to end up having to deal with. But it also drives my decision making in terms of where I've been putting money, where I've been, the type of companies I've been talking about in the newsletter, which really fall into 2 broad categories: discovery stocks and undervalued development stocks, where I've got a fair amount of comfort that at the end of the day they'll either be able to find financing or they'll get taken out and it won't be their problem or our problem. But those are basically the 2 things, in terms of short-term trading. Really, right now, the only thing that's working that I can see really is discovery stories, and actually even a subset of that, high-grade discovery stories. I don't get the sense that traders have got a lot of patience right now with sort of broad, low-grade things. People want to see exciting drill results, exciting trench results, something new that hasn't been gone over. And it's always kind of been my MO to try to find companies where they're working on things that really haven't been worked over, where the targets they're going to attack are, to the extent that's possible in this century, new ones. And in fact, all 3 of the what I would call discovery stories that are in my block, by and large, they are in fact all working on targets that either there's areas of the project that weren't worked on by others before, or in the case of the first guy to my left and the third guy to my left, they're actually systems that no one really ever worked on before. And in fact, in the case of the third guy to my left, nobody even knew it was there before. I love stories like that. I recognize that the risk is higher, and you should too. You should recognize that stories like this, you do need to trade them. You try to get your costs down as things go forward. But I'm a sucker for a discovery story. I'm a sucker for a new target story. Now let's go back to the big stuff again. The big story obviously was the U.S. midterms. I don't think any of us really know what the outcome of that's going to be. I don't know how much difference it makes. I mean, in a legislative sense, I know what difference it makes. For instance, one thing I'm not sure about is I think there was an assumption, and you saw it in the market for about 24 hours, that the trade stuff wouldn't be a problem anymore. I'm not sure about that. I mean, the U.S., generally speaking, this has been true for probably the last 100 years, both houses of Congress tend to cede the ability to negotiate trade agreements to the president. I mean, that's just not a Trump thing. That's been going on for a while. At the end of the day, though, if it is in fact a formal agreement, there generally has to be some kind of a vote in Congress. So I'm hoping that means the trade stuff's going to calm down a little bit, but I'm not willing to make that assumption yet. And certainly based on the way the markets are trading, they're not making that assumption, because we haven't seen the move in base metals we would have seen if the markets had collectively decided the whole U.S., China, and U.S. whoever trade war was not a thing anymore. Clearly the markets still think it's a thing, and they're trading accordingly. The other thing, I'm going to go to this right in the next slide, but there's a secular change that's taking place right now. I don't think it's official. Yields have to move a little bit higher, but this is, I want to stress, this is a secular change. This is not a cyclical change. This is not a small thing, and I don't think we really know how it's going to play out. Just wanted to make one, I'm not going to spend a lot of time on New York markets at all, but I just wanted to throw this chart up there. I know certainly in the last week I've seen lots of stuff out of Wall Street, like, everybody back in the pool, the worst is over, that was it, that was a correction, and particularly after the midterms, there was this big bounce with a big gap you see on the right side of the chart. Personally, I don't think it is. I think odds are reasonably good we're going to see a lower low before this thing's over. It just didn't feel like it was any kind of real washout selling when it bottomed out there at the end of October. I think there's pretty good odds there's another low coming. I mean, I'm not saying there's going to be a big crash or anything. I'm just saying I wouldn't count on everything being clear sailing from here. I'm not convinced it's going to be. But the chart that I think is probably the most important one right now, and note the difference in scale. This is a 37-year chart. What this is the TNX. The TNX is the 10-year bond yield. one thing that you'll notice is this chart, until very, very recently, went from upper left to lower right. And that is to say, since essentially 1981, when Volcker finished wrestling inflation to the ground by running Fed rates up to 20%, interest rates have been in a long-term secular downtrend for 37 years. We really only came out of this trend very briefly in like 2014, 2015. We went right back down to a new low again in 2016. It started climbing again last year. If you take a look at the chart, there's this is a 200, and this is a monthly chart, by the way. These bars are monthly. This is a 200-month moving average. Right now, we're just seeing yields, 10-year yields, and if you did the 5-year, the 20-year, whatever, the charts all look the same. They're coming back up to this. It's coming back up to this 200-month moving average. It has never broken that in the last 37 years. I think this is a secular change. And what's going to be interesting, and I use interesting in the old Chinese curse sense, is that very few people in the capital markets, very few people running funds, very few people running financial institutions have any experience whatsoever with a rising interest rate environment. They have no idea what it's going to look like. They have no idea how to deal with it. And I'm not saying there's any magic bullet that fixes everything. I'm just saying recognize that the markets are probably going to be a little strange here as we make this transition, because I just think a lot of the people in the market, they're so used to having that falling interest rate backstop that they just don't know what to think about a market that isn't behaving that way. This is a very different environment, and I've got no, this time around, I mean, we did kind of have that false start 3 or 4 years ago. I don't think this one is. I think we do cut through that moving average this time. I think we are on our way higher, and I'm not saying it's going to rocket higher and we're suddenly going to have 10% interest rates. I'm just saying that the days of super cheap money, super cheap interest rates are behind us probably for a significant period of time. And that, I'm just giving you a 2-year view. This is actually the same thing, but it's a daily, just a 2-year view. You can see how it bottomed out. The 10-year yield bottomed out last September. It's been rising ever since then. If you take a look at this spot right here where it topped out about a month and a half ago, that's where the S&P started losing altitude. We're pretty close to that again. I noticed this morning there was a fairly high print on the producer price index in the US. It's not really the thing that the market watches. The market tends to watch the CPI and the GDP deflator a lot more, which is what the Fed follows. So the PPI is not like a big number, but it was a surprise to the upside. It came year over year is basically about 2.9% now. So I think people that are hoping for, and I've seen a lot of recent editorials when New York was getting hit, sort of going, well, that's it, the Fed's going to back off now, we're not going to see any more rate increases. I don't think the Fed's going to back off, personally. I think it's pretty much baked in the cake. They're doing another rate increase next month. Unless things really go sideways, I think you got to assume there's going to be 2 or 3 after that, all 25 basis point increases. So I don't think the trend in higher yields has changed. And that affects a lot of things. It's not just that it spooks the markets a little bit, but I mean, bond yields are in a sense direct competition to equities. There's a very well-known interplay between equities and bonds where bond yields are rising, equities, they'll get to the point where they start hitting equities, and then things go in both directions. We're sort of at that point now. I mean, I'm not expecting the equity markets to fall apart, but make no mistakes, this is a headwind. The other thing that it does, sort of at a corporate level, rates go up, it increases the hurdle rate on investments. Investment decisions become more difficult. You tend to see some fall off overall in investments and capital purchases. It also will, I think anyway, start impacting probably one of the most significant tools that Wall Street and the Fortune 500 used for the last 10 or 15 years to boost their earnings and deliver those nice earnings uptick quarter after quarter after quarter, and that's share buybacks. A lot of those share buybacks in the last few years especially were done with debt. Companies were borrowing money to buy their stock back. As rates go up, that makes less and less sense. It rapidly gets to the point where it makes absolutely no sense, and the shareholders themselves will revolt against the idea. And again, that's going to impact Wall Street or any of the big bourses, because that nice, neat way to increase your earnings per share by effectively decreasing the number of shares, doing buybacks and taking the float down, I think you're going to see that really tail off in the next little while. This increases may increase the U.S., in particular the U.S. dollar. That's a tougher equation because it's not really nominal rates, it's real rates that matter. So what happens with that inflation reading is going to matter a lot. If we see inflation start moving so that real rates aren't really going up, you shouldn't see a lot more strength in the currency. You may actually see it reverse if we see real rates come off enough. And of course, real rates coming off is good for commodities. It's particularly good for gold. So that's obviously what we're hoping for. And the other thing that it does is it simply raises the debt burden for everybody, including government. The chart that you see here, that's just one that got generated by Wall Street Journal a couple of days ago, or Bloomberg, I guess it was actually. This is essentially how much it costs. On the right-hand side there, that's the trillions. So basically, it's gone from 2000 to 2003. The interest costs on the debt that the U.S. was carrying was about 300 billion. It's gone from about 400 billion to 550 billion since the early 2017. You'll see this go up fairly fast now because the U.S. is running trillion-dollar deficits, and you're seeing rates go at the same time. The markets shrugged this off, but this is something that I think will become a bigger issue going forward, and it's something that may start impacting things. You may get one of these feedback situations where the Treasury has more trouble selling bonds because the guys that buy these things aren't liking the interest coverage, they aren't liking the amount of debt, the amount of that money that's going to pay off interest, and you get this sort of feedback loop where your bond prices and you start going the wrong way and your yields go even faster. I'm hoping we don't see that, but it's not a completely out of the question scenario, but not a short term on this. If that does happen, it's not going to happen right away. But I think you're going to start seeing the U.S. in particular get called, taken to task a little bit more. I mean, I don't think they're going to be able to just run trillion and a half dollar deficits every year and have nobody care. I think the market will start caring again. Now, I mean, notwithstanding the growth numbers we've had, which have been quite good in the U.S., they've been decent through most of the G8, not fabulous, but decent. You would have thought on that backdrop that we would have had, industrial metals, for instance, doing better. This is a one-year chart for copper on the left, zinc on the right. If you take a look at where copper really ran into trouble in about July, which is right about here, and zinc had its problems starting about the same time too, that very much correlates with where the real rhetoric started between the U.S. and China, and in fact where Trump was running around throwing tariffs at the EU, at China, at Canada, at everybody. That really seemed to spook base metal traders. It wasn't a question of what are the supply and demand fundamentals. It was very much a political argument. It was very much a political blowback, side effect. And to show you that that is in fact the case, you'd think if you saw this kind of chart for zinc or copper or nickel or any base metal, you would expect what was happening was that there was oversupply and that inventories were climbing. Not so much. I mean, here's the inventories over the last year for copper on the left again, zinc on the right. Copper, there was a little bounce recently, but it's not that significant. The current inventories you're seeing for copper are quite low. They're close to 5-year lows. Zinc on the right, Kitco has this weird way of updating charts where they're always like a day or two late. The actual level of LME inventories for zinc right now is below where it was when it was driving zinc prices to $1.60. It's actually lower now than it was 9 months ago. And this is just London, but the story doesn't change if you look at Shanghai. Shanghai is pretty much paralleling it. There's a little bit of metal flipping back and forth between the two of them. Shanghai is actually the cupboards are even barer on the zinc side than they are in London. So, I mean, this is telling me that this is not a supply and demand problem that made zinc go from $1.50 to $1.15, copper go from $3.20 to $2.60. It's a political issue more than anything else. Either that or Dr. Copper is right and things are really going to slow down. We're not seeing that in any of the big economic stats, but that is the other potential answer to this, is that base metals are telling us there is in fact deceleration, whatever the official economic stats that are coming out are. I suspect the truth is in the middle. Things might have slowed a little bit, but I think a lot of the problem with these metals is political right now. And to me, that's an opportunity because that's telling me that once things calm down on the trade side, we should see a decent bounce in most of the base metals. Gold market, well, we're not getting any help there. Basically, again, it's still a victim of the U.S. dollar. The U.S. dollar's actually finally had that move that everybody was expecting, and it actually had another move this morning. And this isn't, again, it's a feedback loop, the currency, the yields, those things are working together. The yields are going up, the U.S. dollar's going up. The U.S. dollar is it's going to start creating some real pain for exporters, that combined with the tariffs. People tend to forget, and I'm not entirely sure Donald Trump even knows that when you set up tariffs, what in fact you're doing is taxing domestic importers. You're not, I think Donald still thinks he's put taxes on a bunch of Chinese guys. That's not actually how tariffs work. It gets paid when it crosses the border on this side. So it's, he's in fact increased everybody's costs. He's made things more difficult because the dollar's gone up. It's made things more difficult for exporters. I know he would love to see the Fed back off, but like I said, I don't think the Fed's going to. And just to give you a sense of what we're dealing with on this tariff side, why it's not a minor issue, this is basically a 120-year chart. It just shows overall levels of U.S. duties on imported goods. They just took them all together, averaged them out. This is how much the U.S. paid in tariffs on everything they were importing as a percentage. And you can see you went through a couple of these periods. You had this trade liberalization early in the 20th century. Then you had Smoot-Hawley in 1930, which is probably one of the stupidest economic bills ever passed and helped generate the Depression, in fact. Countries learned their lesson, and you saw things ease off. World War II, obviously, there were a lot of agreements coming out of that. There was GATT. WTO really became a force in the mid-90s, and again, more decreases in tariffs. If Trump actually puts in the tariffs that he's threatening, and by no means, some of this is just him negotiating, but if he in fact put in all the ones he's threatening, that's how much of a jump you get. You take a look, that takes you right back to where we were in the early 60s. That's why the market's reacting to this stuff. It's not minor. I think a lot of this is going to go away over the next little while, but it's not irrational that the market has reacted the way it has. These are not minor things that the numbers that he's throwing around about, putting 10% on everything in China and taking it to 25% at the end of the year. We're going to have to get past this stuff, I think, for the market to calm down a bit. So with that pleasant backdrop, where does that leave me in terms of what I'm doing with the newsletter, what I'm doing with my own money? With all kind of uncertainty, what's working? Discovery, discovery, discovery. That's what's working. There's two charts here. The one on the left is Great Bear, which you guys probably all listened to about an hour ago. It's one that I follow. The one on the right, of course, is Westhaven, which is the next company that's going to be presenting. This is the power of high-grade discovery. I'm hoping the chart that Westhaven has now evolves much the same as Great Bear's does. Great Bear, I continue to be kind of shocked and amazed at how much that stock holds up and in fact climbs on low volume. It's the float on that stock, the way that it's tightened up is just crazy. Westhaven's got a bit of work to do to get to that point, but this is what Discovery's doing for you. This is clearly what people are focused on. This and very undervalued development stories where, there's a lot less risk. It's not going to have these kind of parabolic moves, obviously, in a development story. But, if your comfort level is you want something where it's there, it's real. Those are sort of the two areas I'm working on. Precious metals haven't been helping us. I don't know when they will. With this story that I've given you on this secular change in interest rates, I'm hesitant to believe. I'd certainly like to believe the U.S. dollar is going to get its head handed to it, but I can't really make that argument even to myself, given the yield backdrop and the yield differential with the U.S. It's gotten bigger. So, I don't think we should assume. I'm actually very happy the way gold's traded the last month. When you look at this backdrop, gold should have actually traded a lot worse than it did. So I'm not actually unhappy with how it's trading, but I'd love to tell you I think it's going to the moon, but I'm not assuming that's going to happen short term. Base metals are pro-cyclical. They should go with the economy. Like I said, the problem they've had is a lot of the problems being political. Assuming that the world economy doesn't decelerate a lot once we get through this trade stuff, and I think it's not going to take that long. One thing I'll say for Trump is when he goes after something, he doesn't screw around. So he's throwing big enough numbers around that there's going to be a settlement or there isn't. I don't see this dragging out for 5 years. I think this is probably a 3-month issue before he and the Chinese sit down and They either come to something or it's just World War III. So, either or. It's not going to get dragged out. So, I think there's an opportunity in base metals just because the market's so negative for non-supply demand reasons right now. The good news is there's no valuation issues that I see in a lot of the other sectors, say in the S&P on Wall Street. Everybody freaking hates us, so we're good. We can all be happy about that. We're not getting overvalued because we're overloved. We're definitely not overloved. Everybody hates us, so that's fine. Things are going to stay choppy. One thing to really watch for is keep watching inflation numbers, because those numbers, as we go forward, those numbers are really going to determine how high real interest rates are. I think the Fed's going to keep raising rates, but it's not like I think they're going to go crazy about it. There will be measured 25-point increases. They know they can't really move much faster than they are right now. So if you do actually see an inflation move, that's when your real rates really drop. And that is when you'll see a move in precious metals, but you'll see a move in base metals too. Copper is actually a very good inflation hedge. So I think that's one thing to watch for. But short term, let's look for these undervalued stories that can sort of get across the finish line. And let's keep looking for discoveries, because I think discoveries, let's face it, that's where the fun is, right? So that's what we're going to talk about from here. And on that note, I'm going to introduce the first company.